Valuation deviations from long-term growth trends is at 158%. Never in record at this level, right? I mean, past the peak of 1929. So, when you look at how deviated earnings are from long-term trends, valuations, long-term trends, markets from long-term trends, you can have a massive correction in this market and still be in a bull market. That's the hard thing for people to understand.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you for another weekly market recap here at the end of the week with my good friend, the ghoulish portfolio manager, Lance Roberts. Lance, happy Halloween, buddy.
Hey, happy Halloween. And actually recording this on Halloween. So there you go. We'll do some extra scary stuff today.
All right. Yeah, some of these topics we have here might be considered scary.
There you go.
All right. Before we get to them, let's just talk about the news of the week. The Fed met this week, they met, they had their release. Powell gave his press conference. Kind of the top highlights of that are the Fed did cut 25 basis points as everybody was expecting. They also announced the end of QT to start on December 1st, which I would say most people were expecting. Mm-hmm. I would say maybe the only real quasi curveball that came out of this was the market has been expecting the Fed to keep cutting from here, and Powell really did take pains to say, hey, look, I'm not saying if we're going to cut or not on December. I normally say we're data driven and we're going to look at the data to make our decision. But I'm saying more than that here. I just want to make a point that if you are dead committed to us cutting next month, slow your roll. So markets had to ratchet down their expectations for a rate cut in December.
Yeah, and I don't think any of that's surprising. Mike and I have been talking about the fact that the Fed would end QT back in January of this year because we were watching what was kind of going on in liquidity in the markets, and that eventually they were going to have to stop QE all entirely. And so, to your point, it was widely expected that they were going to do this by now. It wasn't expected when Mike and I were saying earlier this year. It's just, now it became kind of apparent, particularly with what was happening in the overnight repo markets. So, there's some good and there's some interesting things to that. So, one thing that'll happen is that they're now going to shift all their purchases to Treasury bonds. So if you don't understand what QT is, there's a lot of misunderstanding about quantitative easing. And the first is that the Fed prints money, which they don't. It's an asset swapped with banks to credit reserves in exchange for the reserve credits, which banks can then turn into money by loaning it out. The bank swaps Treasuries with the Fed or mortgage-backed securities. So every month when we were doing full QT or full QE, right, we're doing $35 billion a month in Treasuries. So they were buying these bonds during QE. When we went to QT, they stopped buying the bonds and they were allowing bonds to mature off their balance sheet. That's why the balance sheet dropped. But what a lot of people didn't understand is they were still buying bonds in the market. So when they were down to $5 billion a month in QT, if they had $10 billion worth of bonds mature in a month, they bought $5 billion and allowed $5 billion to roll off. Now, why is that important to understand? Because what they're going to do now is they're going to get rid of their mortgage book. So they have a bunch of mortgage-backed securities on their book that they should not have been buying really they bought mortgage-backed securities to stabilize the housing market back in the financial crisis. And then they started buying mortgage-backed securities during the pandemic, which really they shouldn't have. And I think that the Fed now understands that that's a mistake.
I think
so they're going to allow those mortgage-backed securities to roll off, and all those roll-offs will also be bought into Treasuries. So in other words, if I have $50 billion worth of bonds mature in a month, that much is going to get bought back to keep the balance sheet stable, right? There's not going to increase the balance sheet, but they're going to be keeping the balance sheet stable. So the important thing about that is this now adds a new buyer to the Treasury market. So as the government is issuing debt to finance spending, they've now got the Federal Reserve back into the game of actually buying that debt. Now, they don't, and this is important, the Federal Reserve does not buy debt from the government. They buy debt, they do an asset swap with banks. So the banks, the primary dealers, when the government wants to raise capital, they create debt, right? So they create a bond, we create money through lending. So the government creates a bond, the banks buy the bond, So there's a cash swap between the banks and the government. So governments gets cash to spend, banks get the bonds. The bonds then do an asset swap with the Fed in order to create the flow, so to speak, for quantitative easing or quantitative tightening, whichever you're doing. But that's occurring between the banks and the Fed, not the Fed and the government.
Yeah, and Michael and I talked a bit about this last week, but yes,
Oh, good. Okay.
that is how it goes. And we should probably at some point really just do a refresher for people on this, because even I myself, after talking with Michael last week, had to go back and just watch a few videos to make sure that I was still up to speed exactly on how money gets created.
Well, I've actually got I'm actually writing an article for next Friday
Oh, well, there you go.
on that.
Okay.
This is always the case.
Yeah, exactly. I'm surprised not at all by that. Okay, so I'm glad you mentioned that. So two things. One, to your point about the Fed probably regretting buying market-backed securities during the pandemic. The Fed themselves, I believe, Lance, actually came out and they didn't say we shouldn't have done it, but I believe they did say we did it for too long. So the Fed is actually, Fed doesn't usually admit mistakes, and I definitely noted that. And I'm glad you brought this up, because this was a point that I asked, and I can't remember if it was Michael last week or somebody else this week, but the Fed post GFC was by far the biggest marginal buyer of treasuries, right? They were really driving the treasury market. The Fed has been out of that game for all intents and purposes. Yes, they were buying in the way you said during QT, but it was just to manage the pace of the balance sheet runoff, right?
Correct.
No, they're not stepping in like a QE program, right? But they are going to be increasing their purchasing of treasuries on a going forward basis for the reasons you mentioned, right? Mortgage, they want to freeze the balance sheet where it is now, right? So to do that, as mortgage securities roll off, as you said, they then have to buy treasuries to replace that on the balance sheet. So the Fed will be stepping back into the treasury market more forcefully. My question is how material is that? Is it going to really matter, or is it still too small to at this level to be a big factor?
It's not a huge factor right now. It is going to provide some stability to yields, in other words,
Well,
because
I'm
you are
saying
adding
stability, or
in.
will it actually bring them down a little bit?
It might bring them down a little bit, but let's just assume that for the most part, it just kind of keeps them stable. But what this does open up is the ability for the Fed to return to QE in the future. And so if with kind of what's happening with balance sheet liquidity and those type of things that's occurring, we're seeing what's kind of going on with the repo market, which was the same thing we saw back in 2019. If you remember, back in 2019, we had this issue with repo rates starting to blow out, and collateral was getting very expensive for banks to hold overnight. And so that kind of predated them going back to QE during the shutdown as well. So again, this, stopping QT and just going to not QE, just being flat, it does open up that door for the next step to be a return to QE at some point if needed.
Okay. I guess it does beg the question too. I should pull up I'll try to do it while you're talking next, a chart of the debt, the public debt. But what, pre 2008, we were at what, like 800 billion, right, on the Fed balance sheet? Not public debt, but the Fed balance sheet.
The Fed balance sheet ran at about 300 billion for a very long time, and then it kind of crept up to around 5, 6, 7, 800 billion before the financial crisis. Yes.
Right. So financial crisis hits, the Fed basically doubles its balance sheet during that time. And Bernanke said, "Don't worry, everybody. This is temporary, and we're gonna go right back to normalizing all this and getting back to where we started right after the GFC." And then lo and behold, here we are. 15 years later or so, having hit 9 trillion, right? And then now we're down to 6-ish, and we can't go any lower, right?
Right.
Yeah. So it does. And to your point, I do want to talk a bit more about this. I don't think the Fed is just in love with 6-something trillion. I think what they're saying is, hey, we're actually starting to see some signs of stress begin to emerge in the credit markets. Not crisis, But just
Right.
to your point, we're starting to see, these repo activities start to pick up again. We're starting to see credit spreads start to widen again. We're starting to have some of these cockroach companies, starting to roll over again. And these are all just kind of precursors to what could be trouble in the credit markets, which of course is the thing the Fed wants to avoid more than anything else, because its job is to keep the banking system running when the credit system is essential for that.
Right.
So,
And that was also kind of a key statement that they've been talking about lately, is that we've gone from ample liquidity to just basically some,
steady
kind of
state.
primary liquidity. Sorry.
Yeah. Like a steady state, like we
Yeah.
don't have excess now. We just have just enough to keep things going.
Sorry. Their access, sorry, I misstated that. So their statement is we've gone from abundant liquidity to ample liquidity. So that's, to your point, it's kind of we're to that level where if we go much lower on liquidity to the markets, bad things tend to happen. And so that's really kind of the thing I think they're looking at more than anything else, is that, and to it is kind of ironic. We did QE1, that was supposed to be temporary, and QE1 ended and the market fell 20%. So Ben Bernanke stepped in, did QE2, and market rallied. And then when QE2 ended, the market declined, and he said, okay, we're going to do Operation Twist. And then we had the whole debt ceiling debacle thing, and we stepped in with QE3. So every time there's been, and this is the problem with the markets, right? So, I mean, at the end of the day, I just wrote an article about this recently, that, we've trained investors to buy crisis, because every time there's a crisis of whatever reason, whether it was Brexit, the Eurozone crisis, the fiscal cliff back in
Silicon Valley
2013.
Bank.
Silicon Valley Bank, the Fed has been right there to step in. And so investors have now been trained to buy the dips, right? Just buy every dip, because the Fed's going to step in and bail it out. And, that's not been a bad trade. And this year, buy the dip is giving you one of the best returns of 30 years.
So we're going to talk about your recent piece, which talks about that. But my question for you at this point is, what does it say about not so much the markets, but the economy, that we can't normalize, right? Without things starting to fall apart.
Well, but that's it. At the end of the day, that this is the problem, is that we've all become used to this certain level of standard, right? And we don't want the pain to go back to health. And it's interesting. Everybody talks about, oh my gosh, the debt, the deficits, and all these things are so bad, they're terrible. Okay, maybe, but nobody's willing to go to do what is necessary to reverse that, right? So, you're gonna have to cut spending. You're gonna have to give up a lot of your economic benefits, right? We're gonna have to go into a very deep recession / potentially depression, to get the balance sheet righted again. And I'm not talking about the Fed balance sheet. I'm talking about everybody's balance sheet, to get everybody's balance sheet back into a healthier state. But again, this has always been the problem with government, is that whoever's in office doesn't want to experience the pain, because they want to get reelected, right?
Yeah. And look, I don't want to sidetrack too much on this, but I will give my bias, and you can tell me if you share it or not. Human nature being what it is, the political system being what it is, I just don't see us materially reforming the system and avoiding, some reckoning here. I feel like at some point here, you get to a point, and use the body health analogy, where you've stimulated and juiced and done whatever you can to the body, rather than changing your unhealthy habits. And at some point, the body starts breaking down.
Yeah. No, I've said this for a long time, is that, you've got two choices. We've got two choices right now in front of us, and we could choose to start making small sacrifices today in order to slowly reform the economic system over the next 10 or 15 years back into a much better state of health. And this is really to your point, or we can choose to keep doing what we're doing, and eventually the system's just going to say, nope, we're going to fix it now. And it's going to happen all at once. And it's kind of like your body just basically shutting down, going, you've been smoking and drinking and, overeating for 20 years. Here's your consequence, right? and that's the way it'll eventually happen. Hopefully I'm dead by then, but yeah, I mean, it'll eventually, we're going to keep running this pace until the system eventually buckles. But again, we're not anywhere near that level. We're at 118% of debt to GDP. You've got Japan at 320. You've got Europe well over 200%. So, I mean, we're nowhere near the levels that, we're going to have this exogenous break, within the next year to two.
Yeah, I mean, could it happen in the next year or two? Maybe. Is it likely far off in the distance? Maybe. I don't know when it's going to happen. I agree with you. I don't think it's an imminent, systemic breakdown is like an imminent threat. What I will say to your point, though, is yeah, we could make small changes today versus the much bigger changes reality would force on us on its terms. But I will say the changes we make today are a lot bigger than they would have been had we done this pre 2008, right? Like,
oh, sure.
And
Absolutely.
So I don't want to diminish the fact that actually we've got some real problems here, right?
Yeah.
Yeah.
Well, we should have never done the stuff we did in 2008.
I know.
Right?
We just should have let things cleanse. Yeah.
Yeah, if you would have just let the system, and everybody goes, oh, but if you would have let the banks fail, then that would have been depression, maybe. Reality is probably that no, that wouldn't have been the case. We would have had a very
history
recession,
right? It'd be ancient history, and
we'd have had better for a couple of years.
Yeah, we'd have had better providers step in, and we'd probably be on a lot more sustainable course now.
Yeah, absolutely, and we wouldn't have the debt issues. We wouldn't have all these other issues, but. Again, and again, we did it again in 2020, right? When we shut down the economy, great, shut down the economy. We have a recession, go stay at home. There was no reason for the government to start sending checks to households and the Fed to come in with 120 billion a month in QE. You had another opportunity to cleanse the system without anybody taking any real responsibility for it, right? The government just, hey, we're having to shut down the government because of this crisis. They had a prime opportunity to fix a lot of this stuff. But instead of doing that, we went right back to the old playbook, which was, bail out everything, right? And we just keep doing this over and over again. So we keep the bad actors alive, and it diminishes the health of the good actors.
So you and I think we're talking about this in almost real time because we started doing these things back, I think, in late 2021 or early 2022. Yeah, and it was like you had a perfect gift from the universe to blame all this on. COVID, this pandemic, nobody could have seen coming, right? And you just could have said, man, that was really rough. And man, let's all hate COVID now that it's behind us. Yeah. But hey, we took our lumps and then things were a lot better after that, right? But instead, to your point, we took the deformation and we dialed it up to 11. Okay, exactly. We could keep ranting on this, but I'll move on. My only last question on this is of the stresses that we're starting to see right now, the early signs of stress, anything here worrying you, concerning you, or is it too small to really get nervous about?
Look, as I've often said with you, is that, if you're going to make a prediction about something, it needs to be timely, it needs to be actionable, and those type of things. There are certainly some things that are building up in the market that are certainly concerning, but I don't think those are things that mature. I could be wrong, but I don't think there's anything that doesn't mature until next year. Over the next couple of months in particular, you've kind of got the wind at your back. So as of today, there's nothing that is overly concerning. There's a few things, and we'll talk about them when we get to kind of talk about the market. We'll talk about bad breath. We're going to talk about a couple of other things. There's certainly some short-term technical concerns on the markets, but in terms of, hey, should you be like, really ramping it up into, safe haven type investments in cash? Don't really see that just yet. We don't see any indicators suggesting that just yet.
Got it. Okay. But I guess I just want to give people a useful analogy. So we're not seeing any red lights necessarily on the dashboard yet, but are we seeing a yellow light or two?
Sure. Yeah, no, absolutely. I think there's some things that you need to be paying attention to. Like I said, we'll talk about breadth here in a few minutes. But market breadth, particularly over the last few days, the market ran up pretty sharply, heading into kind of the big mega cap earnings this week. Mm-hmm. And the breadth on that advance was some of the worst we've seen since 1990. So, and again, just, that doesn't necessarily mean that, oh my gosh, this is a terrible thing. But strong markets are not driven by very narrow breadth. You need good broad breadth to drive a market. And we're back to, we were talking about this a couple of years ago about the gap between S&P market cap weighted and S&P equal weighted indexes. And that gap, over the last 6 months is about 12% between two. So the S&P's up 24% and the equal weight's up 12%. You got a massive gap in performance on exactly the same index. It's all a function of weighting, right? That shouldn't happen, but that's what's happening in the markets right now.
All right, and I do have notes here to get into this whole breadth thing with you, and maybe we're just getting to it now. But there's a chart here from Torsten Slock I wanted to bring up here. It gives weight to your point there, Lance, which it shows here, not even just the market prices, but profit margins for the Mag 7. It's pretty much where all the profit growth has been, right? They've all year they've risen for the Mag 7 and they've declined for the remaining S&P 493, right? So it's a K-shaped economy. We've talked about this, not just for people, but also for corporations as well. And right now it really does seem to be a winner-take-all market, where those big AI guys are basically running away with kind of everything, which I guess we'll go straight here then. So my question to you, Lance, is two. Will this only continue from here, and is this healthy?
Well, so first, let's answer the second part first. No, it's not healthy. That's easy.
Okay.
But, look, here's a really good example. Apple reported earnings this week. Apple hasn't grown revenues to any great degree in 5 years, right? Stock keeps going up, making new highs. On a fundamental basis, you would say, Apple's not really growing anymore. It's a very mature company. So I'm going to allocate my money elsewhere, which is a decision we actually made too, into companies that are growing much stronger. But the reason Apple keeps going up is because of the giant mindless robot, right? It's just that passive indexing flow into these companies. And the more that we have retail investors chasing ETFs, and again, now you start talking about leveraged ETFs, not 2-time leverage or 3-time, we're now up to 5 times leveraged on ETFs, that just all feeds those same stocks over and over again. So this bifurcation is being driven by the impact of passive investing. And that has consequences, but only when eventually something happens that causes the passive indexers to sell. And that's the hard challenge. And we can point to fundamentals, we can point to all these other things, but nobody cares about fundamentals. If you're a passive indexers, you're just buying the indexes. And there's so much money that's flowing into that. It's just continuing to create this bifurcation between reality and fundamentals, right? And what's happening in the market and what's happening in fundamentals are two different things. And nobody's paying attention to the fundamentals. And at some point, something's got to happen to cause all those ETF holders to start selling their ETFs. And I don't know what that is. There's going to be some catalyst that freaks the market out and gets them to sell. But that's the only thing that reverts this to any great degree.
Yep. So totally agree. So to my point about healthy, let's assume for a moment that this does continue for the foreseeable future, right? Next couple of years, this trend just keeps going on, right? This is the danger, personally, I think, of this sort of K-shaped bifurcation, right? Is on average, on the headlines, things will look good, right? GDP will continue to grow. Corporate profits will still look good on average, right? But if your economy is increasingly just 7 companies and all other parts of the economy are starving, getting more increasingly starved, that just doesn't lead to a societally good place, in my opinion.
No, that's right. I mean, look, I'm real quick. I'm struggling for a chart here, real quick. I posted a chart this morning on. Oh, here it is. But yeah, to your point about this being a kind of a K-shaped economy, this is small business employment, right? And small companies are dropping employment very sharply, but yet, we're even seeing layoffs with companies like Amazon, Microsoft, others. They're laying off employees as well. So, one of the big challenges. Yeah. And again, this is the whole challenge going forward. AI, this kind of, you take a look at construction spending. There is no construction spending ex data centers for the most part. I mean, data center construction is everything right now. AI development of what's going on, that's where all this spending is occurring. But once you strip all that out, there's not a lot else happening. The economy is actually running fairly. If you strip out AI construction for data centers, the economy is a lot weaker than it actually looks like on the surface. And if you strip out what's happening with large companies and look at employment, it's a lot weaker than it actually looks. So we've got this, and again, this doesn't even talk about the fact of how many people potentially lose jobs once AI comes to fruition. That's a conversation we'll have another day. But, there is a very big bifurcation within the economy between kind of what's happening with the Mag 7 and data center build outs, et cetera, versus what's happening with the rest of the economy.
So I'm going to make an analogy, and I'm curious to hear how accurate you think it is. So it's almost kind of like you're a basketball team, and you are fortunate enough to have LeBron James on it, or a LeBron James type, right? So he
Sure.
helps you win a lot of games because he's great. And so the coach essentially starts stealing food from everybody else on the team to feed LeBron because he's so good and we need to have him,
Mhm.
do his thing. And he gets better, right? He gets even better, even more dominant, right? But you now have this team that is pretty much LeBron James and a bunch of skeletons, right? So it's not good for the other guys on the team. And God forbid LeBron twists an ankle, gets ejected for a foul or whatever, right? Like then all of a
Mhm.
sudden you're just fielding a team of skeletons, starved skeletons, right? Like it's not good. And so, the AI trade could continue forever, for a long time, but it might not, right? There are, definitely risks you and I have brought up and stuff that just, maybe the bloom falls off the roads for one of a zillion different reasons. And if it does and really lays bare the fact that, oh my God, we don't really have we don't really have a healthy rest of the economy to support all this. Again, I just don't think this is a healthy trend.
Yeah. Well, no, I mean, but this is what happens during, this happened during the internet boom back when, you and I were going through the dot-com boom as well.
Well, but
You
it
know,
didn't.
every
It didn't starve the rest of the economy. The dot-com didn't starve the rest of the economy like this.
Well, no, but I'm just talking about expectations were
Yeah.
that this was going to be, the everything thing, and it did impact it, and it did impact a lot of the economy. I mean, there were a lot of jobs that were lost to the internet because of efficiencies, productivity increases, et cetera.
Yeah, over the
And
next
that's
20
what
years,
AI.
but yeah.
Yeah, and that's the same thing that's happened over with AI. I mean, AI isn't going to replace all the paralegals tomorrow, but over the next 10 years, there may be no paralegals left, right? So I'm just using that as an example, but
Yeah.
you know, there's going to be a lot of jobs that are eventually phased out or lost because AI can just do it. But the question will it be as effective as everybody thinks, or will it just become kind of like the internet is? The internet was expected to just take over kind of everything, right? And it was going to replace everything. And really it just became a tool to help people be more efficient. And that's going to be the ultimate question for AI is this something that eventually displaces a lot of work, or does it just become a tool that makes workers more efficient,
Yeah.
right? And more productive. So, there's so many questions out there, but what we can't deny right now, and like I've told you before, my wife's working with a big company, one of the big Mag 7 right now, to build out power for data centers. And that's going to be the next thing, is how to power all of these data centers that are going to get built. And what the end result of that is, we don't know yet, but that's going to be a lot of job creation. That's going to be a lot of support. That's going to be a lot of economic impact. Just the infrastructure side of that. That's when we launched that infrastructure portfolio a couple of months ago, because that's going to be the big driver, at least for the next year or two.
Yeah. Okay. So a couple of things in there. So first off, I think you agree with my analogy and the fact
I
that
do.
okay,
I would have used the analogy of Michael Jordan and the Chicago Bulls, but yeah, to your
that's
point.
fine. I'm totally cool with that. Totally cool with that. Okay. So, and look, personally, here's my biggest fear on the AI side from a market perspective.
Yeah,
I don't necessarily think, Lance, it's going to be a black swan, but it could be. I think it's
sure.
just going to be like most bubbles, where there's just some mathematical point that nobody knows, where the marginal buyer flips to the marginal seller, where they just say, you know what? we've overpriced this thing. We pulled too much of tomorrow's value into today. And then you get that cascade as kind of the market
No,
realizes that, right? So
yeah, no,
I
I
could be
think that's a
wrong.
huge risk.
Pardon
No,
me?
I think that's a huge risk. I think expectations are way too elevated to what reality is going to be, but it's going to take time to get there.
But it's going to take time to get there. But even if that doesn't happen, or if that doesn't happen for too long from now, right?
Mhm.
To your point, the success of AI is going to probably make energy a lot more expensive for
Mhm.
everybody, right? So
Mhm.
not great for consumers. And I actually kind of disagree with you, or I have a different opinion of you, which is
Yeah.
I think AI is going to be much more of a jobs threat than the internet was. Yes, the internet got rid of travel agents and secretaries, right? But those people were able to find other jobs in the economy that the internet enabled. Yes, AI will create some new jobs, but I think on net, if it delivers on what it's going to do, I think it's going to displace a lot more jobs than that. And I think a lot of those jobs aren't going to come back.
No, no, you and I absolutely agree on that. I said what I said was basically that is, I think, the threat. I said the other option is that it's not as big of a threat as we expect because it doesn't work as well as everybody expects, but it becomes more like the internet where it's an efficiency tool, right?
Right,
But
right.
I do think if AI lives up to its promises, it's a huge job threat.
Yeah. So to torture my analogy of the basketball team,
Yeah.
you're starting to get rid of additional skeletons on the team, right? You
But
go
yeah, you're
from
talking about you're talking about fielding the team of the Chicago Bulls with just Michael Jordan on the on the
exactly.
floor
Yeah.
and nobody
It's like
else,
a
right?
two-man team now with him and one skeleton.
Exactly.
Yeah.
It's just one-on-one basketball. That's all it is.
Yeah, yeah, and look, folks, we're kind of looking at the dark side of AI, and I'm sure there's going to be a lot of other good stuff. But I do, to your point on because I'm thinking about this all the time, and actually today's rant is about AI, the good and the bad. Um,
Yeah.
uh, I do think that there's going to be a bright future for the trades going forward for the most part, and I think learn to code is probably the better thing to say to people now is learn to weld, right?
Yeah.
Um,
Be an electrician.
but two things. One, uh, I can see that being like a job boom for the next 5 to 10 years, right?
Mhm.
But then you have all your data centers built out. And you might end up at that point in time with a lot less jobs in the corporate world and then a lot less tradespeople needed because you've done all the build out, right? So you could have a future kind of job demand drought over there. But I think what's maybe just as likely is on the way there the whole AI mania, the bubble may burst, and we may could be wrong. We may slow the rollout of the build out, right? And
Yeah.
so these jobs might not material. These trade jobs might not materialize at the scale that we think they were. So I
Well,
don't
and
know.
there's
It's raising a lot of questions here.
no, look. These are the risks, right? And another risk is that we can't get power developed fast enough to meet the needs of these AI data centers. So, like for instance, we were just talking about one just recently, this whole deal with Oracle and the building out of their data centers is going to require 2.5 Hoover dams and four nuclear or four nuclear reactors. And we just don't
Mhm.
have either one of those. So at what point do you start building this data center going, I'm going to build this and the power will come? But yeah, the power comes, but it's a year or two later before you can get the infrastructure in place. So
Right.
there's a lot of risk that are out there. And that's all we're saying. Look, look, we have an AI model. We've got a crypto model that has AI in it. We've got an infrastructure model. We built models for all these themes, right? Because that's where investing is going to happen over the next couple of years. But you have to go into those realizing that there's a lot of potential outcomes that may not be just as rosy. I mean, you talk about a company like Oklo as an example, which is going to build nuclear reactors. So everybody's like, okay, we have to have nuclear power plants. I'm going to buy Oklo right now. You're paying a massive premium for it. This company has absolutely no revenues, zero, none. They have not built one power plant yet, but it's all on expectations. And that's where you run risk with your investing is that what happens if all of a sudden regulatory requirements change or something happens and building a nuclear power plant takes 3 years or 5 years longer than expected. I mean, there's so many variables that could occur that could undermine a lot of this near-term hype in the markets. That's the risk that investors run.
Yeah. Now, just to look, I'm actually kind of optimistic in the sense that just like World War II and the space race, um, led to all sorts of transformative technologies for us.
Yeah,
Like I think it's probably more likely than not we end this cycle with big breakthroughs in energy, especially nuclear energy,
absolutely.
right? Where we
Yeah.
get much more energy dense at much lower cost solutions, whether
Mhm.
it's super efficient small modular reactors, whether it's somebody actually cracks the nut on fusion, right?
Sure.
I think there probably will be a lot of long-term good technologically coming out of here, but there are all these risks you're talking about. And here's one
Yeah.
last risk. And look, I know neither you nor I are technical experts, but I know you've given a lot of thought to this, Lance. With the internet and other previous transformative technology infrastructure build outs. So, internet, railroads, that type of stuff. Um, the way in which these worked is they were manias, they were bubbles where everybody got into this, threw a lot of capital at it. They
Mhm.
could see the vision. And what we would do is we would basically overbuild, right? So
Mhm.
we built a lot of infrastructure that didn't have immediate demand. And that was sort of part of what led to the bursting of the bubble, where the people realized, like, oh my God, we built all these railroad lines and we're not going to use all of them fully, right? Or we
Mhm.
built all this fiber and a ton of it's going to be dark, right? And then what happened is over the ensuing decades, either the survivors of the bubble burst or new companies came in and they created businesses on that available capacity.
Yeah.
And it was attractive to them because it was cheap, because it
Yeah.
wasn't being used, right?
Yeah. No,
I
great example
wonder,
is Google.
yeah, so I wonder if this time things might be a little bit different, because if we build out all this compute capacity, the chip technology keeps getting better and better and better. And so a chip that was built a year ago is a sub performer in some ways, maybe substantially, to one that's coming out now or next year. So what
Mhm.
happens if we build all these data centers and they end up with stocked with these old chips? I mean, yeah, I guess it does have compute power, but does this stuff depreciate faster than some of the other infrastructure that we built in previous transfer?
Oh yeah, for sure. And if you think about like the fiber, we built out all this fiber back during the dot-com, right? And Lucent and all these companies were building out fiber railways, all across the country. And we had this massive abundance of fiber. And then 5 years later, Google comes along and goes, we have this idea for this thing called YouTube. And all of a sudden, all that fiber capacity lit up, because now we're just think about the billions of hours of videos that people watch every single day. That's all running across fiber.
Right. And those fiber
So
optic cables didn't degrade in that 5+ year time, right?
that's my point. That's what I'm about to
Yeah.
get to. Is that so? One of the challenges is going to be is that we're going to build these data centers, and you're absolutely right. NVIDIA loads it up with Blackwell chips today, and in 2 years they've got a new chip out that's twice as good as the Blackwell. So one of the things that is going to have to get developed is modularity, where these data centers can swap out, and upgrade their technology constantly as technology improves. Because if I'm running, again, remember, somebody's running these data centers. There's somebody building this, like there's a huge data center getting built up by Dallas. And so it's like $50 billion. It's a massive project that they're building. It's just enormous. But in 5 years, if all their data technology is out of date, people are going to go to whatever the new. And how easy is it for me to migrate my data from one data center to another, right?
Hmm.
So so this is a benefit and a curse for the people building the data centers. They're going to have to be forward thinking and think about modularity, to where they can swap components of these data centers out to stay up to date. For companies like NVIDIA, this is a long-term win, because they're going to constantly keep innovating the next new chip that they can continue to sell and create, profits and revenue from. So, the the process of aging out of data centers as opposed to fiber is going to be at a much more rapid pace.
Yeah. All right. Well, that's okay. Super interesting, and obviously, folks, we'll keep on track of this as everything develops. So, last question on this, Lance, and then we'll get to the market specifically. Okay. Just assume for a moment, not saying you're saying this, but just assume for a moment the AI bubble does burst next year, right? What impact would you expect that to have, given the overconcentration that sector has and everything? What
Well,
would be the knock-on effects of that? Let's say
well,
these stocks go down 40%.
the markets will be down 40%, because the stocks that make up make up 40% of the index roughly now are all tied to AI. So if AI completely falls apart in the next year or two, you're going to have a market decline because it's unlikely that if those big 10 stocks are declining, and this is that event I was talking about earlier where the passive indexers finally sell, it's really not going to matter that you own energy or financials or staples. They might get some minor rotation during that decline, but the index is going to fall much faster. Think about 2022 as a kind of an antithesis of what I'm talking about here. In 2022, if you owned a bunch of stocks like Roku and ARK investments, that type of stuff, your portfolio was down 60, 70, 80, 90%. Market was down 20, 25 at the trough. And that was because all these big mega cap companies held up. They were down a little bit. They were not down nearly as much as underneath the surface of the market. There was a lot of devastation. So the market appeared to only be down 20, 25%, depending on, but your portfolio was vastly different depending on what you were invested in. If you were very speculative, you got hammered. In a decline like you're talking about, if AI peels apart, then that's going to be in those big mega cap stocks. They're going to drag the whole index down. And unfortunately, it's going to drag down a lot of those related trades with it. So, companies like Palantir, Palo Alto Networks, Salesforce, Broadcom, Oracle, you just kind of start working your list through those companies. Those are all going to get hit really, really hard.
Okay.
If that occurs. I'm not saying that's going to occur. I'm just saying, answering your question, if it occurs, it's going to be that 30, 40% decline. But here's the good news is that in a 30 or 40% decline, we're still in a bull market. So, there you go.
And again, yes, I prefaced all this by saying this is just an intellectual exercise. You're not calling for this to happen. But because
I'm not calling for that to happen.
But because we are in an environment now where the market tail really has now wags the dog in terms of the economy. And the economy is largely being carried right now by the spending of the top 10 to 20%, right? The negative wealth impact. So you could shrug and say, 40% stock market drop. Yeah, that hurts, but we'll survive it. But would you also expect there to be economic knock-on effects because of this? One, from the negative wealth effect to the people who've been carrying the economy. And then secondly, if all these firms have been investing in AI, also there's just all of a sudden a lot of corporate uncertainty that comes along with this too.
Yeah, no, I mean, you're going to have big impacts to earnings. The economy will go into a recession at that point because you will get a curtailment of spending as that negative wealth effect, triggers, and people are going to cut back spending, they're going to cut back investing, those type of things. So yeah, I mean, no, nothing's good as going to come out of that. All I'm saying is that if this market is so deviated from its long-term bullish trend that a 30 or 40% correction won't be a bear market.
Right, won't break
It'll
the
be
trend.
A correction within a bull market. That's the hard. And the reason I'm saying that is that's really hard for people to wrap their head around about how deviated this market is from long-term means. Valuation deviations from long-term growth trends is at 158%. Never in record at this level, right? I mean, past the peak of 1929. So, when you look at how deviated earnings are from long-term trends, valuations, long-term trends, markets from long-term trends, you can have a massive correction in this market and still be in a bull market. That's the hard thing for people to understand.
Yeah. And of course, then it begs, well, geez, if we actually ever flipped into a true bear market, how gutting would the size of that correction need to be?
Yeah. Now you're talking 60, 70%. So, and hopefully, now you're talking depression era type sell-off, and let's certainly hope we don't ever get to there.
Okay. All right. Well, thanks for going through. I did not have this much discussion of AI on my bingo card to put this together. So there's a bunch of topics I'll probably have to push off to next week. All right. Back to the news of the week. We have so President Trump has been in Asia. Looks like we're close to two big deals coming out of that. One with South Korea, of course, one with the big kahuna, China. And nothing to my understanding has been signed yet, but there's been a lot of real positive handshaking and backclapping and headlines coming out of that. I know generally you've said, Lance, that these trade deals are kind of nothing burgers to the market. With China, does that remain the case, or do you think that this may actually have more impact on where stocks go?
Well, it removes uncertainty. What the problem has been, like, a couple of Fridays ago, the market was down like 2.7% on the whole news that we were going to put 100% tariff on China. What markets don't like is uncertainty. The tariffs really have very minimal impact on what's going on in the economy. They're a one-time impact, and then it's done. It happens mostly with producers. We've talked about this before. But what markets don't like is this on again, off again, on again, off again type thing that goes on. It's like, oh, I'm putting a tariff on today. Well, no, I'm taking it off to, we're going to negotiate in this whole stick and carrot thing we've talked about before. Markets don't like that. Markets like certainty. They want to be able to look forward and say, this is what earnings are going to be. This is what profit margins are going to be, and stick a tariff on it. That's fine. As long as I can factor that in, I'm okay. But when you're if you're, imposing a tariff, then taking it off, imposing it, taking it off, and changing it, it's really hard for Wall Street to factor out what that's going to look like in terms of earnings, profits, and margins, which is that's the only thing that Wall Street cares about. And that's why there's such a high correlation between forward earnings estimates, the annual rate of change in those estimates, and the annual rate change in the S&P 500. They're very high correlated because that's what the market's pricing off of. And if the markets can't establish with some firmity about what that's going to look like, it makes it very difficult for markets. So yeah, just getting a resolution to China, getting this out of the way so we can start talking about something else, that'll actually be good for markets.
Okay. All right. Speaking of markets, we got earnings from most of the Mag 7 out of the way so far. Mm-hmm. What has this earnings season been telling us?
It's been fantastic so far.
Really? Not if you're Meta.
No, Meta was awesome. If you look at Meta's earnings, their revenue growth and their bookings, etc., it was a stellar earnings report. They took a $15 billion charge on taxes. It's just an accounting adjustment, and that's all that was. And so the stock took a hit on that, but that's going to be very short lived. In fact, we'll be adding to Meta in our portfolio probably in the next couple of days.
Oh, really? And I don't want to rattle on Meta. I thought it was because they basically said, look, we're going to have to really keep spending a lot to stay in this AI race.
You know what Amazon just said? They're going to spend $160 billion, and the stock's up 10% today. So that doesn't really carry water. And I had this debate with Michael. He said the same thing to me. He's like, no, it's because they're having to spend so much money. No. Every company's ramping up their CapEx expectations. It was solely that revenue hit that they took on the tax charge. It's a one-time effect. It's done. It's over with. Right. You look at their revenue growth, earnings growth, et cetera, they were all stellar.
Okay, last point of this, and I can't remember if it was percent of revenue or percent of something else, but it seemed that Facebook had a higher percent of, I guess it's revenue of CapEx spending, meaning it was having to spend more on a relative basis than these other guys. Maybe that was just a headline in the moment. I don't know.
I think that was a headline in the moment. No, all Meta said is I think their previous range was like 62 to 72 billion. And they raised it to 68 to 72. It's just the top end of their range.
Okay.
So and again, but fundamentally the earnings were great. But even beyond that, let's just go back to kind of what we're talking about. In fact, I wrote about this earlier this week. 85% of companies are beating estimates right now. And this isn't surprising, right? It's millennial earnings season. So we came into this. We had been ratcheting earnings lower earlier this year. And then when we had the Liberation Day and, he held up the sign of all the tariff rates, analysts slashed earnings and cut like $40 a share off of earnings during that whole, April sell-off. And once that resolution was done, they ratcheted earnings back up, but lower than where they were before Liberation Day. So they came into earnings season way underestimated. They were too conservative on estimates, which set the bar low enough that every company could basically beat earnings. And that's what's been happening. So you have one of the highest beat rates we've had in 20 years. But overall, companies have done very, very well. Revenue growth, we've got a very low number of companies espousing any type of economic concern. They're all like, the economy's fine, it's doing great. Forward outlooks are good. So now this has been a very good earnings season.
Okay. How do you square that with the bad breadth of the market? If everything's looking good for everybody, how come everybody's not participating?
That's a whole nother question, because it's been very interesting, particularly in the last few days. As we talked about earlier, you take a look at the number of stocks above their 50, 75, and 150-day moving average. That's been absolutely just collapsing over the last year. I've got a chart for you real quick. See if I can get away sharing something with you. But this is from SimpleVisor, but we track the number of stocks above their moving averages, and you can see just over the last 4 trading days, it's just taken a complete fall off here, especially the number of stocks above their 50-day moving average. And if you take a look at breadth, this was breadth of the market this morning before the market opened, and it's pretty much just the Mag 7. The rest of the
Mag
market,
7, yeah.
is
Go
really
back to that other chart for a sec.
Yep.
So who knows what's going to happen next, folks, right? But this to me seems like something you would, if there was a material market correction, this is something that you would point to retroactively and say, oh, this was an early tell.
Yeah. And I think that is a reasonable, there's an old saying that, markets are strong when breadth is strong, and markets are weak when breadth is weak. And it makes complete sense. You just got a handful of stocks that are driving the markets right now. And it's just this whole kind of concentration that we've seen occurring in the markets as of late, which continues to be concerning. Again, we normally have we run a diversified portfolio. So we've got some defensive stocks. In fact, I got a really good call earlier this week. It's like, why do we still own Costco and Walmart in the portfolio, right? Why don't we just own more of Nvidia and Amazon and Apple, right? Because that's all fine, because those stocks are working right now. But when this market does correct, you're going to want to own the Walmarts and Costcos of the world, because that's where money's going to go to. Yeah. And so you need those defensive offsets in your portfolio to handle volatility in the markets. And this is the thing that really where people screw themselves up investing, is they start piling into the same levels of risk assets across the board. And in other words, if you take a look at assets, when correlations all go to 1 and you own all the assets that are all correlated with each other, when the market sells off, they're all going to sell off at the same time. So it doesn't give you protection. So you've got to have some diversification in your portfolio for things when the Mag 7 sells off, and they will for whatever reason. You've got some assets that money's got to go somewhere. Money just doesn't leave the market; it just changes where it is. It's like the old definition of energy. Energy just changes form. Yeah. That's what happens in the market. So if money leaves tech, where your thinking has got to be is like, okay, if money leaves tech, where's it going to go to? Money typically rotates into areas that have good, solid fundamentals, dividends, stability, those type of things. That's the Walmarts, the Costcos, the Exxon Mobils, the Procter and Gambles of the world, right? I mean, those old boring stocks that nobody wants to own. That's where money tends to rotate to, and that's why we spend a lot of time on we've talked before here on the show. And when we start talking about, kind of markets in general, is talking about rotational analysis of the markets.
Hey, I'm going to ask you a question and just to integrate your answer and what you're saying here. Yep. I think a lot of investors, when they worry about overvaluation, they think of like a 2008 style collapse where kind of everything went down, right? Talk about the probability difference between that, right? Where like capital, to your point, flows into T-bills, right? Because everyone's just freaked out and they're going to safety, versus capital leaving the overvalued parts of the market and rotating into the undervalued parts of the market. Which happens more frequently? The latter. What you need, so remember, let's go back and talk about 2008 for a quick second. So in 2000, and so in March of 2008, whatever, you had the Bear Stearns crisis, and then markets rallied back to all-time highs. And then they started selling off a little bit, going, kind of into June, July, August, September, and money was rotating into defensive areas of the markets. And it wasn't anything drastic. We just saw some offense to defense rotation. What caused everything to collapse at one time is when they forced Lehman into bankruptcy. Then all of a sudden, nobody could trade anything, and nobody knew what was going to happen next. So at that point, you just sell everything and go to T-bills.
because I don't know, you've just done something that's never been done before. You forced a bank into bankruptcy and you've frozen all counterparty trading. I don't know how to deal with that. So I just put everything in the T-bills. So in an environment where you just have a normal correctional rotation, you're going to see money rotate from things that are massively overbought and, into things that are typically very oversold. And this is a good example of this. Here's technology way up here, relative and absolute conditions. It's some of the most overbought levels we've ever seen in technology. Down over here,
all by itself in that quadrant.
Yeah, it's all up here. Here's everything else down here, right? So here's staples, energy, transportation. They're all down here. Materials and financials are deeply, deeply, deeply oversold right now on a relative and absolute basis. If we switch this over to factors, which is a little bit better kind of view of the markets, because this is kind of where investors are investing right now. Mega cap growth. So this is the mega cap stocks. It's up here all by its lonesome in the upper right-hand corner. S&P 500 growth, it's up over here. High beta stocks up over here. Down here at the bottom, mid-cap value, Dow Jones micro-cap, buyback achievers, low beta stocks, small cap value. These are the most oversold sectors of the market. So, as a portfolio manager, what we're starting to look at is these areas down here and say, where are some good opportunities in low beta value? What stocks exist in low beta value that might be worth considering? And so this is where you can kind of dig in a bit and look at things like real estate. If we get a risk off rotation in the market, that's going to pull yields lower, which will benefit real estate. So you got DT Energy, WC Energy, and again, this goes back to energy being very oversold right now. There's TJX companies. I mean, these companies are very oversold in that sector, and these stocks have very strong valuations to them. So that's where money's going to rotate to from a safety perspective.
Okay, and I think that's an important thing just to make sure that people get here, which is that emotionally we fear the sinking tide that sinks everything. Yeah. Right. But you're saying what happens much more frequently is usually, capital just rotates from one part of the market to the other. And therefore you don't necessarily want to get out of the market, or at least not totally, but you may want to, consider moving your capital in advance to some of these areas that are kind of being left for dead right now.
Yeah. Let's kind of work that through real quick. So let's just say, for instance, we're going to have that there's a catastrophic event coming. Okay. You and I don't know what it is, but let's just say September 1st of next year, there's this catastrophic event that's going to occur, right? So we get out our tarot cards and we can make this prediction. And Magic 8 Ball. Don't forget the Magic 8 Ball. Gotta have that one.
Or the Ouija board.
Or the Ouija board. So, but you and I come to the agreement that September 1st at 8:35 a.m. on a Tuesday morning, whatever day September 1st is, the markets are going to crash. Well, between now and then, right, the markets are going to start sensing that there's something wrong with the market. Credit spreads will start to widen. We'll see economic data begin to show some impacts. We'll see earnings, start to slow down dramatically.
A few more
and markets will start to rotate, and you'll start to see the fractures in the markets occurring. And that's your early warning signs that you're going to see. And that's where you start doing some defensive rotation, raising some cash, adding some extra T-bills to your portfolio. Nothing drastic, but just paying attention to it. Then as markets start to come down, we're above the 20-day moving average right now. So we take out the 50-day moving average, get a little bit below that, rally to the 50-day fail, and then go down, take out that low. There's another technical indicator. Hey, something's changing in the market, dynamics changing, need to be paying attention, reduce some risk. This is what we're talking about, profit taking, rebalancing, those type of things. Continue that process. Then you take out the 100-day. Things are a little bit more serious. 50 starts to turn down and starts heading towards the 200-day moving average. Market comes down, tests the 200-day, bounces off of it. That's good. Maybe we're out of the woods right now, but then it rolls right over, takes out the 200-day moving average. You've probably got something on your hands right now and want to reduce risk even more. And then September the 1st comes and the announcement comes out, whatever it is. And markets are down 10% over the course of the next week. It's okay. You've already positioned for it. You've already been raising cash. You've already been rebalancing. So now when the market's down 10, you're maybe down 2 over the next week. And but you have cash, you've got stability in your portfolio. And now I can start picking through the rubble going, hey, you know what? They're throwing the baby out with the bathwater here. I'm going to start picking up NVIDIA that's down 80% from its peak and still growing like a monster. I'm going to start buying some NVIDIA here. I'm going to buy some Amazon that's down, or, I'm going to buy some Meta that's down 60% over the last, 3 months. That's how good investing works over time. And that's why, I just published a desktop trader's guide on our website under our resources library, because it's 181 rules from the greatest traders of all time. And what they all say is none of them say buy and hold, and none of them say, sell the bottoms, right? It's, sell the peaks, buy the bottoms. And that's what you want to be working on.
Okay. It sort of sounds like buy low and sell high would be a good investing strategy.
Yeah, imagine how that would work.
All right, and kind of in the spirit of this, I always hesitate to share what I'm doing personally because I don't want people just to copy it because it might not be the appropriate thing for you given your specific situation, which again is why I always tell people it's always good to work with a good professional financial advisor who can give you specific advice. But we've been talking for a good while now, Lance, about how the energy sector has been largely overlooked, particularly the fossil fuels, right? The oil, natural gas. I did just take sort of a foundational position. I'd had some exposure, but I increased it to what I would sort of consider to be my 1.0 position in this space. I am fully prepared for lower prices ahead. I can definitely think of things that could make oil go lower, in the near term and whatnot. But I am, through our previous conversations, at the point where I feel like its prospects over the next couple of years are looking good enough to me to say, look, I want to have some upside exposure to that. And I could be wrong about these fears about lower oil prices ahead. And so if I am, I don't want this thing to take off on me while I'm sitting there waiting for a dip that doesn't happen.
Yeah, so like we own a couple of energy stocks in our portfolios right now, but I'm actually building a 100% thematic energy portfolio to add to our thematic portfolios, because I do think there's downside risk to about $40 a barrel on oil, but that's going to be a cyclical issue, economic cycle, kind of market cycle type issue. But if you get down into the $40, kind of $45 range on oil, which is kind of where my target is over the next couple of years, that you're going to have an opportunity to own some high quality assets that are going to generate a lot of return, both in income as well as capital gains, over the course of probably the following 3 to 5 years.
And if you are correct on that, my plan is to dollar cost average in on the way down.
Yep. And that's kind of the purpose of this thematic portfolio, is to do exactly that.
Okay. I had a note here on the energy thing just to mention, we were kind of, chuckling because you mentioned this before we turned on the camera. But we just had Bill Gates, surprise a lot of people, kind of doing a reversal on the existential threat level of climate change. And folks, I'm not making a pro or con argument on this. I'm just noting that Bill Gates softened his stance. And there are probably a number of reasons why he did that, but I do think the timing is such that it's hard not to look at that and say, he had one set of values up until he realized how much energy Microsoft needed to be successful going forward in AI. And, a lot of that's going to be provided at least by natural gas, probably some other fossil inputs, and said, "Ooh, you know what? Maybe fossil fuels aren't as bad as I was out there saying."
Yeah. Well, I mean, look, this has always been the problem with whether or not you believe in climate change is entirely up to you. That's your, priority. The problem has always been, though, is that we have an economy that's highly dependent on oil. Oil is in everything, from the food you eat to the clothes you wear to the computers you're watching this on right now. It's in everything. And the problem with
it is not slowing.
Yeah. And solar and wind are great. There's nothing wrong with them, but they're not as efficient in terms of providing the power needed for building out the economy, much less powering AI data centers. Like I said, just what Oracle is doing with their investment is 2.5 Hoover dams. You cannot create that type of electricity demand, generation with solar and wind. So it's not surprising at all that Bill Gates is backing up, going, okay, I said before that it's an existential crisis. It's not really we need to be paying attention to climate change. Look, I mean, there's no doubt that we need to be conscious about what we do to our environment. It's where we live. And we need to be doing things as clean and as healthy as possible for the ecology and for the environment. Absolutely. Nobody's arguing that point. But at the same time, we also have to sustain our ability to grow economically and to meet these goals that we're trying to do. And Bill Gates understands that the amount of energy required to run these data centers is just enormous. And you're not going to get that from any source other than oil and natural gas.
Yeah. And also part of this, folks, I would look at this as almost an example, and maybe this is a bit of a stretch, but almost an example of Michael Every's, mercantilist model, which is that in a mercantilist system, governments just do what they have to do, and they will steal from one part of the economy to feed another part of the economy if that part of the economy is strategically important to the nation's interests. And AI, from my perspective, this appears to be the arms race, the nuclear arms race of this millennia here, where we have just said as a nation, if we want to remain the superpower of the world, we have to win this. China's already way ahead of us on electrical production capacity, and we got to do whatever we got to do. So I think you're going to see, maybe some unnatural reversals of certain policies or certain attitudes, all in service of this. Hey, yeah, in a perfect world, we'd love to take care of all this stuff, but we got to win this one thing first.
Yeah.
Yeah.
Yeah. And look, Bill Gates was right in his statement. He said the people that are hurt the most are the people in the lowest quintile of the population, right? The poor people. They're the ones that are most impacted by the impacts of climate change, et cetera. And we need to do more to help those individuals. And he's right about that. I mean, this is where we go back to economic policy. We need to ensure
I think I'm not sure the AI build out is going to be very beneficial for those same people.
Right. Well, but that's my
get
point.
rid of their
This is where
jobs
we
and
need
increase
to.
their energy costs. Yeah.
Right. Well, but that's where we've got to be conscious of that, right? Is that, so for instance, things we can think about. If Microsoft is building out a data center that is absorbing all the cost of, or increasing the cost of electricity, they have to pay an additional tax for that electricity usage to balance it out for just normal people, right? So if you have one consumer that's overweighing the grid, and I don't have the answers, I'm just throwing out examples, right?
Right.
But you've got to come to some type of structure that manages the cost of electricity for people who aren't involved in AI, just trying to pay their bills, right? And that's kind of point of Bill Gates' argument, is that we have a level of the population that is going to be heavily impacted by this, and we need to figure out economic policies. And I'm not talking about tax credits. I'm not talking about giveaways and those type of things, because those are terrible for the population on that end, right? You give them a tax credit, everything they want to buy goes up in value because the provider knows they've got a tax credit for it. So the tax credit is completely absorbed, and it just makes their situation worse. But we need to focus on economic outcomes for that group of people that makes it more equitable for them. Job creation, those type of things, things that will allow them to prosper within the economy alongside of the development of this other stuff. Again, I don't have the answers, but these are things we need to start thinking about now rather than later.
So I'm right there with you, brother. I guess I'm just going to say the skeptic in me says
we're all skeptical.
I'm not going to hold my breath. I just feel like we're potentially just going to trade one set of insults to that category of people for another. All right, look, we got to get moving on here. So if we could do the TA real quickly, Lance, if you can just tell us where we are, and along with it, only if you want to. If not, we can save it to next week. Talk to your recent piece, the most dangerous era in history, or potentially the most dumbest era in history.
The dumbest era in history,
The
yes.
dumbest era, yeah.
Yeah, we can get there. If we have time, we can get there. Hold on a second. Let me, I need to dress up my chart here real fast.
Because I do have two other topics that I'm pretty sure you're going to rant on.
We can do the most dangerous era next week. And because I've actually got a follow-up piece coming out on Monday.
Okay.
So
So folks,
Uh,
if you don't want to wait until next Monday, go to realinvestmentadvice.com and read Lance's most recent piece there. It's a good one.
yeah. So this is the TA. And as you know, not surprisingly, there's not a lot of change going on. Two things that happened over the last kind of week in particular is that we had broken. So a couple of Fridays ago, we had that big 2.71% sell off, took us down to the 50-day moving average. That correction was needed but it broke this bullish trend line that we had been in for really kind of ever since the April lows. And then the market kind of gyrated around. We tested the 50-day a couple of times, held that support, then climbed back above the 20-day. That was all super bullish for the markets, right? So bull market still intact. Nothing wrong with the markets right now. We got back above that bullish trend, and we're just trading within that trend channel right now. That trend channel is compressing, right? So at some point, we're going to break out of this trend channel in one direction or the other, and wherever that break is going to be, potentially significantly lower. So if we break to the downside, you're talking about a retracement back to at least probably 6,600 initially, so that could happen. But one thing, kind of if there's levels of concern for the markets right now, we talked about breadth. That's one. Two is declining money flows. That's this orange shaded area in the background. Money flows are declining. So participation in the market is declining on multiple levels.
Okay, but
and we have a negative divergence in relative strength, which is also typically a sign that you want to be careful of. Last time we had negative divergence in relative strength was heading into March and that April sell-off. Go ahead.
Okay, sorry, but just on money flows, you expect that to increase going forward now that companies are coming out of their blackout windows, correct? And they can do buybacks again?
In theory, yes. We should see a pickup in money flow. Then I was about to get to the three pushes for the end of the year.
Okay.
But yeah, starting on Monday is the beginning of the seasonally strong 6 months of the year: November, December, January, February, March, April. So your returns in January, November, December tend to be running around 7% in total. So the bias is to the upside over the course of the next couple of months. However, even saying that, the first 2 weeks of December, typically you get a sell-off in the markets because of mutual fund distributions for the year. They have to distribute all their capital gains, interest income for the year. So you typically get a sell-off in the markets. That could be something that reverts the market back to the 50-day moving average as an example. And then you get a rally into year end as they position for their year of end reporting. But between now and the end of the year, you've got 6 trillion to 7 trillion a day in stock buybacks. You still have a lot of momentum in the markets. Professional managers are way underweight the indexes right now in terms of their portfolio positioning. They're going to have to ramp that up for chasing performance into year end. So we should see a performance chase between now and the end of the year. And then, of course, earnings are very strong. So you've got a lot of support from earnings between now and the end of the year as well. We saw Nvidia coming out. They report late November. So that'll be the last of the Mag 7.
Okay. So you and I talked a few weeks ago after I'd had Mark Newton of Fundstrat on the program. He's a big TA guy. He said, I think odds are more likely there's going to be some, pullback in the market in October or November. And he said, right now, from what I can tell, I'm going to see it as a buying opportunity for a rally into the year end. You agreed with that at the time, and that seems to be the way the script is playing out. So I guess my question for you, Lance, is beyond that softness you think we'll see in the first half of December for the reasons you mentioned, have we had the pullback and it's now, the dip was bought and ride this into the end of the year?
Right.
Yeah.
Yes. Sorry. I thought there was more to that. Look, the market's been weak over the last few days. So again, I think this market could drift a little bit lower here, but yeah, I think anything that gets you around the 20-day moving average, the 50-day at the most, you need to be buying it into year end. I think you're getting a little bit of just market exhaustion right now. And then we kind of work through this over the next week. And if Trump gets a trade deal done with China, we get some, what would be great is we get the shutdown over with and start getting some economic data back out. That would be helpful. But I think all that should be at least supportive of markets over the next couple of months. Now, let me just say this. There's no guarantee of anything. So you need to make sure you're managing risk in your portfolio. So, if you have, just like recently this past week in the crypto model and the AI models and the infrastructure models, we did a little bit of rebalancing because we had stocks that had just run off to the moon. So we just rebalanced those back to target weight. So make sure that you're following your procedures, rebalance your portfolio to targets, raise a little bit of cash. Just because you sell something today to rebalance it to target doesn't mean you have to buy something today either. So holding a little bit of cash here is a good opportunity. So if we do get a pullback, you've got some money to invest.
Okay. All right. So we're heading into the home stretch here. You just mentioned the shutdown.
Mhm.
Um, I guess first off, let's say it doesn't resolve anytime soon. How worried are you about an impact on the markets if this goes on for more weeks?
It's been interesting. It's like, part of me goes, what shutdown? Does anybody realize there's still a shutdown going on? So
I'm kind of going here with this question. So anyways,
yeah, yeah,
talk
the
about the market
market,
impact first.
yeah, the market really hasn't cared very much, and I don't think it does care at this point. There's always this, when you go into the shutdown, there's always catastrophic warnings. It's like if we shut down the government, we're going to default on our debt. This is going to happen, and of course, we said back then, it's like, no, that's going to happen. Don't worry about it. And I think markets are largely looking past it. They know this will get resolved and probably get resolved before Thanksgiving. The markets have been very good about shifting their focus to other data to kind of get some
Hmm.
indication as to what's going on with the economy. So, markets are starting to look at ADP reports, paychecks reports, trueflation data, that type of stuff to try to get a gauge of what is going on with normally government data that they trade off of. They've been getting it from other sources, which I think is actually a good thing
I was going to
as
say, is
well.
this actually a kind of a healthy transition where we're
Yeah.
like, you know what, all that problematic government data everybody's been so breathlessly
Mhm.
anticipatory of, maybe we just don't really need it that much.
Yeah. And again, you take a look at the surveys, the survey data, it's like the participation rate in those survey data or reports have just dropped off a cliff. Nobody,
Yeah.
nobody participates in them anymore. So yeah, no, I think it's all good, honestly. But again, but don't be mistaken. As soon as the government ends the shutdown, we're going to go back to looking at the economic data from the government, right? That's not
Well,
going to change.
it probably won't, but do you think we'll place as much weight on it, or will we now have a better balance between that and some of these other private sources?
Well, I think it depends on who you're talking about. With the media, no, the media is going to pay attention to the government data, right?
Sure.
They're just going to report what comes out. I think there's a lot of managers like us, even that have already shifted. And we did this a long time ago. We have not always relied on government data. We've always used alternative sources for kind of understanding what's going on actually within the economy. And I think a lot of other managers have now kind of started to at least incorporate this other data within their processes as well. So yeah, I think it's a good thing.
Let me ask you this. A relatively new entrant to the private data portfolio has been these betting markets, right?
Mhm.
Like Polymarket, right?
Yep.
Where you're crowdsourcing and people are putting money on the line, so presumably they're thinking hard about this before they commit too much money. For things like politics, they've been surprisingly accurate. How do you see them as a financial indicator?
I think it's too soon to tell. We don't use poly markets much in our analysis. And so, because the sample size isn't big enough. I think though, if poly markets really takes off and you get a really big sample data set, let's say you've got 1 million people using this, I think it becomes a lot more accurate in that part. Part of sampling is you need size.
Yep.
And if you have a very small sample size, your outcomes aren't going to be very good. This is the problem with government data, that the number of people participating in the survey
Right.
has declined so much that the accuracy of the data is becoming less reliable. And so again, no, I think it's a very interesting data set. We do look at it. We don't put a lot of weight on it, only from the function that the sample size isn't that big yet. But if it does get to a major sample size, then yeah, I think it becomes a lot more important to the markets.
Okay. Yeah, I just think it's interesting.
I
And it's
do.
funny. I will say, when it first came on, I sort of discounted it like, it's just people, kind of gambling. But the accuracy of it in
Mhm.
other spheres has been big enough where I'm like, oh, maybe it actually could be kind of
Yep.
interesting and helpful in finance.
Yeah.
Okay. So this is not the rant, so we won't spend a ton of time on it. But to your point about the government shutdown, um, I'm pretty sure this is true. I remember listening, I think it was a year or so ago. Apparently the Canadian government had shut down for, I think, 2 weeks, Lance.
Right.
And like nobody noticed. Like I don't think it was widely publicized in Canada at the time.
Right.
And pretty much like nobody noticed, right? And to your point, and you're saying it somewhat tongue in cheek, but like, yeah, the government's been shut down for over a month now, and like business as usual is pretty much,
Mhm.
continued. So it does beg the question, and I'm not saying this, raising it to be antagonistic to anybody with a government job, and I have people in my family that work for the government. But it does beg the question of what do all these people actually do? And the question of like, how many of these jobs do we really need? How much of the government workforce is really kind of make work jobs versus jobs that are essential to running this country? So I've got another question, but I'll take a pause for a second.
No,
Thoughts?
no, I think, look, this has always been my thing about government shutdowns is you terminate 900,000 people, you furlough them, right? You furlough 900,000 people, and the government still operates. And look, there's certainly some things that are not, we're not getting government data as a good example. So there's things that are certainly missing because of, people not working. But we're all concerned, and this is the interesting argument, right? So everybody's concerned about the debt, right? This government debt that we have. Well, a big chunk of that debt goes to funding government operations. So, maybe this is a good time where we should all sit down together and say, okay, we're going to reopen the government, but when we start hiring people back, let's just hire back the people that we need to hire back instead of just everybody, and start really thinking about reforming the employment structure of the government, et cetera. How many people do we actually need to run the IRS, as an example? I don't know the answer, but just pick a department,
Yeah.
whatever department is, Department of Energy, Department of Commerce, Department of Education, whatever. How many people do we actually need to run that, and rebuild the government that way? And you could save, begin saving money and reducing the cost of running government. But again, we don't. Unfortunately, we just don't do that. But it seems to me, just as a layman, that this is a prime opportunity to start rethinking about who we actually hire back and what we actually fund.
What was so interesting to me, and it's not unlike academia, right? Where, from what I understand, it's just really hard to fire teachers, especially tenured teachers and things like that. Where in government, and I think we're seeing this right now, where the current administration is saying, hey, we think we can actually, we've been thwarted in a lot of our downsizing attempts, and we think that the shutdown actually gives us the legal authority to not just furlough some of these people, at least in the executive branch that we control, where we can actually do some RIF, some reduction in forces here. And the blowback on that has been tremendous, right?
Yeah, they're immediately sued.
Yeah, which is, it's just a sign that it's really hard to
Yeah.
fire government workers, right? And so I don't have a strongly informed opinion here, but just these things that we're talking about, like, hey, a bunch of people are furloughed. We haven't really seen that much diminishment in terms of the services being provided. We have a lot of questions about whether all these jobs are needed, and we don't really even have the ability to do what you're doing. It's not unlike nutrition, right? Like, oh, if you have some health issues, one of the first things a doctor might say to you is, well, you know what? Cut a bunch of things out of your diet and then start selectively adding them back and see if they make you feel better or worse, right? Like your idea is a totally fine, sane idea, and I'm not trying to diminish the fact that you are impacting people's livelihoods here, because this is all great in theory until it's your job that gets removed.
Right.
But
Yes.
but the government should be running for the benefit of the people, and it shouldn't be having fraud, waste, and abuse, right? The whole call of Doge.
Yeah.
And the fact that we just make it so hard to even just try to test and get the data and see what's going on here, to me, just sort of smells like kind of like academia, where it's really where the system really protects its own.
Right. Well, what gets me is that, I hear a lot of people, they complain about the debt, and then they say, what's going on in government's wrong, and all these people need to have their jobs back, et cetera. You can't have both. Right. You've got to pick an argument at some point about, are you worried about the government debt, or, do you want government to run the way government runs? And because you can't have both. You can't reduce the debt and have government run the way it runs. It's just not going to happen. You can't keep funding all these programs and reduce the debt. So you've got to pick your argument at some point and then build a case for it.
Yeah, and I'm totally fine if the debate shifts into like, you know what, we don't just want to put all these people on the street immediately, and so let's have a program where we're identifying places in the private market where these people can go to, whatever.
Sure.
Fine, if we want to have that, great. I'm all for it, right? But I think we should be able to, you know, look at how we're running the business of government and say, how can we make it work harder for the American people? All right,
Yeah.
last question on this, and I realize we're probably dancing around territory, maybe even fully stepping in it that might, you know, not be popular with everybody watching this. But another thing that this government shutdown has raised is questions about supplemental programs. So things like the SNAP program, right? Food stamps or food relief, right? You know, I think you can probably get most people to agree to say, look, you know, we want to be a generous nation, and in times of true hardship, we want to try to help people find a way to make it through that hardship. But you know, a lot of these transfer payment programs end up having people that never get off them, like a large amount. And so with SNAP, right, the number was what, something like 40+ million households are on SNAP. And so the headlines are, of course, is, oh my gosh, you know, if the SNAP program gets delayed, you know, tens of millions of people are going to be in danger of starving, right? And it raises a bunch of important questions that I don't necessarily have the answer to, but I'm just saying we should all think about these as intelligent citizens of our country, which is, what should the purpose of these programs be? Are these essential programs? So SNAP, and I think I've been super transparent about this. You know, my mother in her later years was on government assistance and was on SNAP, right? So I know that the help and the difference it can make in people's lives. But there's a bunch of private solutions out there, charitable organizations, food banks, et cetera. Like it is rare that somebody in America is truly going to starve and not be able to find food if they can need it. So one of the questions is what is the government's role here, period, right? Is this something that can be done better by the private and charitable sectors? And then two, if the government should play a role, for how long? How much and how long, right? And I'm not actually necessarily looking at this as I want to save the government, you know, dollars and cents argument. I'm asking it more of, do I want us to be creating dependent classes that never get off of this stuff, right?
Yeah.
And human nature being what it is, if you shelter them from enough of the pain of true need, human nature being what it is, people will just say, well, I can just live like this, right? And I don't think that suits anybody's interest in the long run.
Yeah, so two things. One is that I've always found it fascinating. I didn't come up with this. I was reading an article about the impacts of supplemental nutritional assistance programs on the U.S. economy. And one of the statements that was made, I know you've heard this before too, is that if you go to a national park, it says, please do not feed the animals because they become dependent on the food that you feed them, and they don't learn to hunt for themselves. And that's from the Department of Agriculture. And the Supplemental Nutritional Assistance Program is also run by the Department of Agriculture, where we're feeding people and not teaching them to fend for themselves. So it's kind of interesting, you know, we understand that if we feed bears, that it creates an environment for them not to take care of themselves. But yet we are willing to do that with 20, 30, 40 million Americans, right? So, you know, and there was also a study out recently, and they were actually talking about this on the radio this morning because this is a very hot topic right now, but that the mental state of people that are fully on SNAP, as an example, or EBT cards, and that's all their income, they psychologically lose their ability to have self-worth, right? So, you know, I'm just giving money, and their need to aspire in life gets diminished, right? You lose that need to progress because you're being fed, right? Just like the bears. So, you know, there's no easy answer to this, but, you know, a work requirement, you know, might be very useful in this. It's like, look, you are entitled to have, you know, if your income is less than a certain amount every year, you are entitled to have some supplemental nutritional assistance, and we want you to have that. But a couple of things that go on with that is that, one, it should only be used for nutritional quality foods, right? So I can't buy alcohol with it. I can't, buy junk food with it, et
Right.
cetera. I've got to buy
And,
milk and eggs
and if you
and
look at the
bread.
top 20 things that are being bought, I mean, like
Yeah,
17 of them are what I would consider junk food. Yeah.
correct. So that would be step one. And then say you have to have a work requirement. So if you want to buy the other stuff, right, you can use the money you make from your work requirement, no matter what it is, right? You can buy your junk food with that, right? Whatever. But at least you're out, A, contributing to society, and hopefully, as you're contributing to society and working, that you start working yourself into a position where you no longer need supplemental nutritional programs. And so there's a lot of there's a lot of things that, when the Affordable Care Act was first being put out back in 2009, 2010 under the Obama administration, there was a lot of studies out at that time about providing, further assistance to certain groups of people. And and they were showing people that they figure out how to game the government system with all the different programs,
Yeah.
and they can make $50,000-$60,000 a year just gaming the system.
And why wouldn't you if you could, right? Yeah.
Correct, right? You're on EBT, you claim disability, you do all these other things, and you can make a lot of income and not work. And look, there's always going to be that group of people. There's no way around that. There's always going to be people that figure that out. But I think you could provide some very base level requirements just to help encourage better outcomes. Then again, we do that for the bears, but we don't do that for human beings.
You mean, and so the reason why I'm raising this, and again, it is absolutely not to beat on people that are currently depending on these programs, but is very much what you just said there, Lance, is, it creates this dependency, which I think is toxic, and then it creates generational dependency, right? Children grow up in that environment and think, oh, well, this is how it's done, right? And
That's how it works.
it
Yeah.
just propagates. And one of the reasons why I'm particularly concerned about this is AI, which is if AI indeed is the jobs eater that I think it could be, right? When you raise that risk to the people who are the big AI fanboys, where do they go? Oh, well, we'll have universal basic income, right?
Yep.
Which is essentially exactly what we're talking about here, right? It's just creating
Exactly.
more and more dependency, right? And so I worry that as bad as the system might be right now, it could get a lot worse if we graduate to that place. And so I don't know. I just think this is one of those things you're saying, like if we don't grab it now, dealing with this problem later on is going to be way bigger and way more painful than it is today.
Right. Yep.
Yeah. Okay. All right. Why don't you tell us your recent trades, and then we'll get to the full rant and we'll wrap up.
So really just on recent trades, none this week. We had done some repositioning. We bought some Amazon, Nvidia, some other stuff, last week, kind of before the market ran up. So, again, portfolio's in a good position right now. It's doing well. Our thematic models are doing exceptionally well. Again, I did a little bit of rebalancing this week and a couple of the thematic models, just because things like Bloom Energy is up like 400% since the lows. I've taken out more in profits out of Bloom Energy than, I'm taking out twice as much in profits in Bloom Energy than what I actually invested in the company. So, it's been just a phenomenal run. So just, again, I think important is just to continue to monitor your portfolio and do some rebalancing and just manage that risk. Because again, we're going to get a correction here at some point, 3, 4, 5%. It's going to happen. When it's going to happen, I have no idea. But you want to have a little bit of cash kind of on the sideline. So when you do get a correction, some of these stocks that maybe you owned, you can buy a little bit cheaper, or stocks that you've wanted to own and haven't been able to get into, when they correct, you can finally get some money put into those.
Okay. All right. When and if that correction happens, well, it'll happen at some point.
Yeah, we're gonna have a correction at some point.
Yeah,
not a crash, but 3-5%. It's going to happen.
Yeah. But when it happens,
December
you
the
and I will
1st
hyper
at
dissect it.
2:17 a.m. Yes.
We will hyper dissect it for everybody in real time as it happens. All right. Well, let me get to a rant and then we'll hop off of here.
Okay.
So we've been talking a lot about the potential dark side of AI. It definitely has a light side, and I just want to be, I want to be transparent. There's definitely a lot of good in there with some of these concerns. I had a really interesting experience yesterday with AI, where a kind of a friend of the channel had I invested a couple of hours working with AI to understand thoughtful money, the thoughtful money business. They were curious about it. They did all this analysis. They ended up giving it to me. It was like getting like a 20, 30 page report from McKinsey. I mean, it really was super useful and helpful. And one of the things that they did is they use the AI tools a lot more than I do. And certain tools have certain strengths. And so they would have Gemini do one part of the analysis, and then they would have Chat GPT then review the Gemini analysis and then add its capabilities to it. And then they would have Claude take a look at that. And so again, you get this really rich report, and you get kind of these AI programs evaluating and riffing off of each other. It's really pretty cool. So anyways, this can be a tremendously valuable market intelligence tool, and I'm sure I'm not telling people anything they probably didn't already realize about it. But I want to read a part from the analysis about the thoughtful money audience, because this channel is nothing without the audience that comes here and supports it. And again, I get a lot of kudos for what we do here. And I tell people, look, it's almost entirely undeserved because I have the easiest job in the world. I just listen to what you people tell me you want, and I do more of that, right? But after this guy did the research, he said, "Man, I got to tell you, Adam, you've got such a great audience there at Thoughtful Money. I'm totally envious of what that business has created in terms of a followership. And because all you watching this, you are the people that have made that literally happen. I wanted you to hear what the report has to say about you." So this is a little long. Bear with me. It might be a minute, two at the max, and then we'll get going. Okay. The analysis reveals a highly specific and valuable investor archetype, herein identified as prudent protector. This individual is not a casual consumer of financial media, but an active, sophisticated investor seeking to safeguard significant wealth against perceived systemic and macroeconomic threats. The prudent protector is an experienced high net worth individual, typically between the ages of 45 and 65, who has successfully accumulated wealth and is now in a phase of capital preservation. Their primary financial objective has shifted from aggressive growth to the protection of their family's future and the establishment of a durable legacy. They're characterized by a deep-seated skepticism of mainstream financial institutions, official economic narratives, and conventional investment vehicles like stocks and bonds, which they often view as being in a speculative bubble. This worldview drives them to actively seek tangible, non-correlated assets that offer a hedge against their core fears of inflation, currency debasement, and systemic market failure. Now, Lance, I know you might say, okay, there's a little bit too much pessimism and negativity in there, but I think that captures a lot of the common concerns that we hear from people about the markets as they are today. In short, the thoughtful money follower is a conscientious learner, someone who might read economic reports for fun, track financial news closely, and engage in discussions about how to thrive amidst global challenges. They appreciate content that helps them think critically or thoughtfully about money. This psychographic profile, financially savvy, sustainably minded in terms of wealth, longevity, and personal responsibility, aligns well with investments that are both financially sound and grounded in real assets. So to me, that feels very largely accurate about what I've learned about this audience. And I think that is, if that sounds like you people, I think that is largely something that you can take a lot of pride in. Again, Lance, you might chime in and say, hey, look, you still have to play this game, and don't be so conservative that you're leaving additional prudent growth on the table. But I would also say prudent growth is something that the prudent protector here is, it participates in. So anyways, I wanted folks to hear that. I'm going to hand the baton to Lance in just one second. That said, that I think is an AI win. I want to talk about an AI fail. So oftentimes when I'm searching for a name on YouTube, how it auto fills out what you might want to be searching for, it'll put net worth at the end of it, right? So if I'm typing in, I don't know, Lacey Hunt or, Darius Dale or something like that, it'll put net worth up there. And I've seen it so much, I was like, I wonder what it thinks my net worth is, right? Because I've always wondered how accurate these things are. So there are two.
Then you're gonna get everybody. Then you're gonna get everybody googling Adam Taggart net worth.
Yeah. Well, they can do it now. But so there are two Adam Taggarts that tend to get picked up in the media. One is an Australian soccer player who is way cooler than me. And it estimated his net worth between $2 and $3 million based upon whatever it could find, right? For me, Lance, it estimated 20 to $50 million.
I knew you were doing really well for yourself. That's awesome.
Yeah, no, but folks, I mean, I'm not even in the same freaking solar system as that, right? And so it's a warning that yes, AI can hallucinate, and I don't know how it came up with that number. I don't know what it was using to extrapolate on that. It is so far off, it's comical. I'm pretty sure it didn't get the soccer players' net worth correct, but I am sure he has more than I do. So, anyways, you know, as cool as AI can be for like market research like this, it can get some stuff colossally long like that. And Lance, don't think I didn't go then search on Lance Roberts' net worth. And it wouldn't give it to me. It just said, you know, oh, he had a radio show and he's got a firm like this, but we don't have enough public information.
Exactly, because I hide my assets very well.
But I mean, I think I've got a lot less to go from, so I don't know why it came up with that. But anyway, so folks, so
That's funny.
there's good and
Well,
bad.
so there is an African American underwear model named Lance Roberts, so you may get his net worth though.
Really? So you and I have these other avatars that are way cooler than we are.
Yeah, exactly.
Yeah.
Exactly.
All right.
Yeah, so I spent, before I came back to the United States, managing money, I used to hide assets for clients overseas. So yeah, you're not going to find mine.
Okay. Okay. Well, look, I do want to hand the baton to you though, because as I understand it, you guys are really leaning into AI pretty hard at RIA. So how are you guys using it right now?
Well, so we're developing, so on SimpleVisor, we use AI a lot. In fact, we're developing a whole suite of new tools for AI to help individuals manage their portfolios, et cetera. But internally, within our own work, we're starting to use a lot more AI in terms of modeling out, financial, trends, et cetera. So if we're looking at, for instance, power generation, right? We're starting to use AI a lot more in helping us determine which companies are the leaders in those specific areas, which ones have the highest touch rate on, say pipeline generation in Nevada, wherever, to help us, refine down our research into specific companies that we're looking for.
Is it just as simple as asking it questions? Like, give me a list of the top companies for XYZ, or
No,
what's the process like?
you can do that, but you get a lot of garbage. So it's we've been developing, and we actually hired a guy in our office. His name's Bing, and he's our CTO now, and he's really developing a lot of AI tools. So we basically go to him and say, I need an AI tool that'll do this, and so he's developing these AI tools to help us do our research. But we still have to filter out. At this point, there's still a lot of garbage in that data. So we still have to figure it out and filter it out through our more traditional metrics, but it is getting better. The more we refine it and keep put it, and to make AI work, it's all about prompts. And so you've got to give it the right prompts. And so the more that we refine the prompts, get more specific, get very granular on what those prompts are, specifically telling it to ignore certain data sets, look at other data sets, those type of things. Your answers start to get a lot better. But if you just go in and say, give me 10 stocks in the AI space, you get a lot of garbage.
Got it. Two things. One, that the person who did the AI report of Thoughtful Money told me that he said a really good kind of like hack with AI is after you've done your prompt, after you've gone through your prompts and you've gotten to the answer you want, you then ask the AI, hey, if I had wanted to get to this, or something even better than this result, what would the best prompt have been? And it will actually generate good prompts for you to use going forward, right?
Right.
Yeah. Okay. And then, so prompts are super important. And then with things like the type of analysis that you're asking it to do, are you telling it to go out and scour the data sets, or are you feeding it data and say, analyze this data and give me an answer?
Both.
Both.
It depends on what we're doing. So, trying to think. So, so recently, there's been a lot of topics about, central banks are, buying all this gold, right? So, we actually downloaded the actual data sets from the central banks and said, okay, here's the actual data sets from the central banks. tell us what central banks are doing in terms of gold purchases and a function of their percentage of total reserves. And so it analyzed that data and gave us the results of that. So, and sometimes we're doing that, but a lot of times we're telling it to either use specific data sets or allowing it to use whatever data sets it want, as long as those data sets are validated and verified and accurate, right? So sometimes we let it kind of have a little bit of free reign too.
Okay. So 2 weeks ago, you were explaining about how the narrative of central banks buying more gold was really not quite that accurate, and you showed a chart. Was that chart the output of your
Yeah.
your AI exploration there?
Yeah.
Okay.
Well, one of them, and we've got a couple of them now, but that was one of them.
Okay. All right, folks. Well, hopefully you've found this discussion of AI interesting, and one of the reasons why I wanted to have it was one to reflect back to you the very nice write-up, I think, and accurate write-up that AI had of you. But also, you've heard that saying, you're not going to lose your job to AI, likely, at least in this first wave. You're likely going to lose it to somebody who is using AI well, right? And so hopefully we're giving you ideas on how you can be using AI if you're not quite a engaged user of it yet. But I don't know. It's, we've got a long way to go in this whole AI journey, and there's probably going to be lots of pros and lots of cons, as we were talking about earlier. But folks, if one of the greatest pros in your life that makes you most efficient and just enhances your quality of life is to continue to listen to Lance Roberts on his channel week in and week out, please let him know that by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Real quick, if you didn't watch our fall online conference that aired 2 weeks ago, you can still buy the replay of that over at thoughtfulmoney.com/conference. And if you would like to lock in your ticket for our spring 2026 conference at a 0% inflation rate, you can do that by going to thoughtfulmoney.com/2026. Lastly, if you would like to get some help from a good professional financial advisor in managing your portfolio for the road ahead, whether it's in the short term or the longer term, especially if they end up playing out like Lance has shared with us here that he thinks they might, then consider scheduling a discussion with one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. Perhaps you'd like to talk to Lance himself and the team there at RIA. To do that, just fill out the very short form at thoughtfulmoney.com. All right, Lance, my friend, another great week. Great discussion this week, I thought. Really good to have you back. You're looking good. Hope all's going well with your wife. I'll let you have the last word here.
Nope. Thank you very much. It is good to be back. I'll be out again in 2 more Fridays because that'll be our next chemo treatment. But other than that, I'm here next week. So yeah, looking forward to it.
All right, brother. All the best to you and yours. Everybody else, thanks so much for watching.